Thank you for joining us on the Rich Roots podcast, and we're really excited to have you on today, Vessi. I would love it if you could just, kick us off with some intro to your journey and how did you get to where you are today?
Absolutely. Well, first of all, thank you, Radhika and Vibha, for having me on. Really, it's a pleasure to be here, and I look forward to an insightful conversation and adding value to the listeners. My name is Vessi Kapulian. I'm a former commercial lender turned real estate investor, although my journey started many, many moons ago behind what's now known as the Iron Curtain. So I grew up in Bulgaria, so at a different time, different place. And I think that's when really the root of real estate was. Real estate took roots in me because at the time not many people, well, there wasn't really a developed stock market to begin with. So when people talked about investments, they talked about hard assets, but it was always my dream to come and study in the US. So first step one was learn English. Step two was focus on academics because that was the only way I could afford to come here. At night, I remember listening to my little radio to a show called The Voice of America. So that's how I practiced my English, studied hard, and finally made that dream real. And it was exciting to come to the US. And at that point, I took on a more traditional path of going to school, getting good grades, getting a job within the corporate world, and then starting to climb that corporate ladder because that's what success looked like to me. That's what success was painted as. And a few events of adversity around market crashes, the global recession, several corporate restructures left me feel really scared. Well, what if this happens to me? And even worse, what if it happens when I'm 60 and the market collapses and my retirement portfolio is decimated? Or what if I'm out on the street unemployed at that time? So I started thinking, well, what can I do? I don't control market events. I don't control corporate restructures, but what I do control is my investment choices. And at that point, I think the that seed of real estate that was planted in me germinated, and I resorted to real estate. I started with a single family home that later turned into a duplex, later turned into an 11 unit. And before I knew it, this wasn't just some small retirement nest egg. It was an opportunity to create a steady income stream that would provide much needed cushion in the event of duress. And so that's how I got started. I'm active in the multifamily space today as an investor as well as consultant and advisor to investors, and it's been a great journey to be here.
Wow. That is one incredible journey. I mean, I think so much of what you had to go through required gumption, right? Courage to learn English and to get here and even starting with a traditional uh, corporate job, which both of us also started from a very similar mindset of get good grades, get into college and then get a steady job to climb the ladder. So yeah, I think we can certainly resonate with where you started. How has your definition of wealth or even financial freedom now evolved over time?
That's a great question because I think it started in a more traditional way, right? Wealth equals money. Having gone through life and different experiences, to me, it means so much more. Health being one very important component, and whether or not you've gone through a health event, right? It's something that we, at least for me, I tend to appreciate more and more as the years pass by. And the other component being the freedom to, it has a number of components: geographical freedom, personal freedom, relationship freedom, time freedom, right? And money, right, is a vehicle that helps us achieve that freedom. And how you make money, there are different ways to do it, right? It's, for me, that vehicle ended up being real estate. It's not the only vehicle, but that's one of the many reasons. One more item I would like to add, it's also impact. I view that as a form of wealth because we're here for a very short period of time on this earth, and the impact that we leave and what we leave behind, to me, is really important. I want that to be positive. And again, so money becomes an enabler of that mission of achieving wealth, not just physical wealth and riches, but health and the legacy that you leave behind.
You have a company. It's called DBA Capital. Can you tell our listeners what is the mission behind DBA? What do you hope to do, and what is the type of impact that you are hoping to leave behind? What is your legacy
Yes.
essentially that you're trying to build?
Absolutely. So DBA, it stands for Dream, Believe, Achieve, and there was a lot of thought that went behind the name of the company. But for many of us, right, it starts with a dream, a goal, and having a clear why. Why do we want what we want? Then belief is overcoming those limiting beliefs that we all struggle with at different points in our journey of growth, as well as surrounding ourselves with positive, like minded individuals who can help take us a step or two further along that journey. And achieve is stands for taking action, because none of this would be possible if we don't take action. And usually taking that first step is the most scary and the most difficult, yet the most important one, is to just get started and focus not so much on the end result, but on the activity, taking those consistent daily actions step by step. And before you know it, when you look back, you will see growth and the results that follow. And so with that in mind, I started Dream, Believe, Achieve, because I, unfortunately, after many years being in corporate, I was also impacted. Thankfully, while all these restructures that I mentioned were taking place, I didn't sit back thinking, oh, I got spared because I'm the smartest one there. No, I realized I was very lucky and very probably very underpaid. So that's probably why I was scared. The question was, oh, what do I do? Right. And that's when I doubled down on investing in real estate to create that additional income stream. And thankfully for me, when our entire division was shut down and my colleagues and I had to bid farewell, I had options to consider. I could stay in corporate, that was one option, or I could focus on growing my business, which I wanted to do eventually, but I think the universe decided that I should start now, not 3 to 5 years from now. So that's how the company started. But I want to be able to provide that optionality to people. And it may not be the same as mine, right? And hopefully I don't have to face that choice and a layoff scenario, but it could be, hey, I want to be more focused on the family and I don't want to work full time anymore, or I don't even want to, I want to work maybe part time. And it provides them that income stream that they can lean on during life events or during events of duress. And secondarily, in addition to providing that optionality to high achieving professionals, business owners, I'm also on a mission to empower and educate investors. So a lot of the content that I produce and share is educational in nature, because we all work hard for our money, right? And this is investing, so it comes with risk. It's not risk free, but I often feel that, especially in today's world of technology, many investors tend to fall for social media impact and impressions and the know, like, and trust factor, which is a very important factor, but it's just as important to understand the numbers, understand how investments work, so you can make in an investment decision that's right for you, right? Everyone has a different risk tolerance, everyone has a different investment thesis. So my decision may not be the same as yours, but I would like people to have the tools and the information so they can make an investment decision. And so I believe an educated investor is an empowered investor.
Viv and I also focus on with our investment company. And you're right. And I like we tend to focus even, I think, more narrowly on women and minority investors because just like you, we there's limited, I think, opportunities that we were taught about as we at least we were growing up. You actually learned about real estate as, in Bulgaria and that, but coming from India, like myself and Viva, this was not talked about in our circles when we were growing up. So these were alternative investments that we had to learn about as adults, and I think sharing some of that, talking about it, and educating women, especially just with their purchasing power in the world now, I think it's so vital for them to create these additional income streams. So I'm going to transition a little bit. Vessi, can you talk about how did your corporate career in banking. How did that transition over to real estate? Like, were there any specific skill sets that made you really excited about and why you entered real estate specifically?
Yeah, so for me, first of all, as far as my corporate career, I was a commercial lender for 15 plus years. I started from the ground up, worked my way up up the ladder, and I was financing middle market international companies at one point of time when there was an opportunity to take a promotion. I transitioned to the domestic department, and in that particular office, a huge chunk of the business was commercial real estate. And so, even though I had some exposure in my prior role, that's when I really doubled down on it. And I realized pretty quickly that I'm sitting on the wrong side of the table because I saw a lot of full-time investors who are basically making a living from investing in real estate. Primarily it was apartments, there were some commercial, retail, industrial, and then special asset types that we finance. So between that and the different events that happened and some of the story I shared, that prompted me to take a step back and think, well, what is it that I can do that generates that additional income stream? What is it that cash flows, holds its intrinsic value? Real estate came as a vehicle. And so I think having the lender background really positioned me well to transition into the space, because as a lender we evaluate a lot of aspects, right, when a deal is presented to us. But we ultimately, what we look for is the risk, understanding the risk and how that is mitigated, and thinking through the downside, which I think is really important perspective to always an investor. Now, when I started investing, I did have to take a step back and learn the investor's perspective, right? Which looks at the upside, the opportunity, the money, the money that you, that's important, right? If everything is doom and gloom, right, you'll never get a deal done. So it's important to be balanced, and it definitely took some time and to transition to that. And I wouldn't say I'm all the way into the investor spectrum today. I'm probably somewhere in the middle. Still haven't given up my lender roots, but that, I think,
Yeah,
positioned me well to look at both. Even today, when I look at deal, is to look at the downside, because at the end of the day, why we want to protect, at a minimum, we want to protect the principal. Of course, the probability of loss is there, but if you can at least protect the principal, you've done well, and then everything else from there is on upside. So from that perspective, I think it really positioned me well when analyzing investment opportunities presented to me today.
yeah. So I'm hearing you kind of talk about conservative underwriting, right? So could you give us an example of what that looks like in practice, especially for LPs who might be seeing deals for the first time? What should they be looking out for? What's a good example in today's market of a conservative underwriting?
Yeah, so, and I hear that term thrown a lot. So definitely, I would say to the onion if someone's telling you to be conservative. And I do a lot of posts around that. I also go into a lot more detail into the a private community that I have that's focused on underwriting. But ultimately, it boils down to understanding the key assumptions that the sponsor is using to create the pro forma cash flows and the pro forma valuation, which ultimately drives the pro forma returns for an investment, and really understanding how realistic those assumptions are, whether or not they align with actual supportable third party data. That's first. And secondly, how does it align relative to their past performance, right? If someone has maybe optimistic assumptions, but in the past they've over delivered consistently, I'll probably lean into that a little bit more. But if it's someone who hasn't done this before, maybe they've consistently under delivered relative to what they said previously that they would do, and they continue to think that they're the best, that their deal is the best one in town, the last one you ever see, right? I'll approach that with a grain of salt. But there are two particular levers, and we can definitely go into more detail for investors to pay attention to. One is the entry and exit cap rate, and then the rent assumptions. Believe it or not, even though we've gone through a couple of crises now, the Great Recession of '08, the COVID downturn, and the 2020 to 2024 downturn, even today I still see projections that are, I think, a little bit um, I don't want to say out of bounds, but outside of my own risk tolerance, let's just put it that way. In today's market, I mean, we are I think rates have peaked, and who knows, right? We can definitely talk about the current macro environment, but a lot of people are of the mindset, well, rates will fall, cap rates will fall. So more often than I would like to, I see deals that assume declining cap rates, which has an exponential impact on the valuation of the investment. And so I see their investments who look great on paper, but can turn from hero to zero very quickly. And even just the other day, I saw a deal where the rent growth assumptions were around 3%. And you may think, okay, that's kind of the national average, so that's not unreasonable. But as I peeled the onion, that particular submarket or that particular pocket where the deal was located was growing between 1% and 2% a year. So 3% year over year, I think, is a very aggressive assumption. And if you think about it, that 3% compounds year over year. So again, it has an exponential impact on the valuation. So there's definitely a lot more to go into as you peel the onion on a deal. But if there are at least two, I don't want to overwhelm the listeners, but if there are at least two to focus on, is start there.
So can you actually take a step back, Bessie, and help explain what is a cap rate and how do they analyze that?
Yes. So a cap rate is effectively the rate of return on investment that you would generate if you bought that property all cash. And it's in place in order to allow for people to compare properties across the board who may have different debt structures, right? And once you layer in the debt, then the returns, you're not comparing apples to apples. So it's one that's very commonly used in the commercial real estate space. And so how it ties to valuation is in the commercial space, very similar to businesses, right? And businesses are typically valued based on an EBITDA multiple. So in real estate, you can think of the cap rate as the inverse of that multiple. And so it has an exponential effect, and the equivalent of EBITDA, or earnings before interest, tax, depreciation, and amortization in real estate, that's the NOI, or the net operating income. So how you derive the valuation of the property is you take the NOI, or the net operating income, and you divide it by the cap rate to come up with the valuation. That's a methodology that appraisers use, investors use, many people in the space use. So not getting the cap rate right, as you can imagine, can have a pretty devastating effect on your pro forma valuation. And naturally, if the market is really strong, assets are trading, cap rates tend to compress, right? Because there are a lot of investors for that asset. But if the market is not doing well, if it's in a distress, which is what we're going through right now, at least in the multifamily space, each asset class is at different stage of the cycle, then cap rates start to expand, right? And so if you're assuming the market will get stronger, you're probably then thinking cap rates will be compressing, which pushes your exit valuation higher. If you think the market will get worse, or if you want to give yourself some wiggle room and bake in some cushion, it's more prudent to assume the market will get worse before it gets better. At least that's how I like to underwrite my deals. So I always assume cap rate expansion throughout the duration of the deal. And look, if it doesn't happen, if the market is really strong at the time you exit the investment, then you've bought yourself even more cushion. But if it is worse, then you've at least accounted, maybe not for all of it, but at least for part of it. So hopefully that answers the question. But if not, I did a whole live event actually on LinkedIn on cap rates. We can definitely talk a lot about it.
No, I think that was actually really helpful. And I especially loved kind of your tip, right, on expanding the cap rate throughout the deal, just because if worst case scenario, you get more money at the end of the day if the market does better. Are there other tips or tricks of these that I think are a little different than how most people underwrite or do the due diligence on these deals? Do you have any few more that you could share?
Yeah, so in terms of underwriting, I think probably one of the most important steps that people miss is understanding the market, because I mentioned assumptions earlier in our conversation, and the market is really the source for most, if not all, of these assumptions. So not understanding that can lead to multi-million-dollar mistakes. And what I mean by that is understanding the underlying trends in terms of population growth, job growth, because a lot of that median household income, right? Because a lot of those factors drive the demand factor, the household formation factor, which are extremely important when we are evaluating multifamily properties, right? Because our ultimate clients are the residents who live in these properties. Median household income, right? That's a driver for affordability. So if someone's coming to you saying that this is a $59,000 median household income market, I immediately know, okay, my rents are going to be capped at 10 to 1200 a month, right? And so if someone's coming to you saying, yeah, you can add golden handles and quartz countertops and you can charge $1,500, like, oh, mate, I don't know who that tenant will be. Maybe there are one or two out there who will pay $1,500, right? In the current median household income environment, unless they coop up with 2, 3 families per apartment, right? They just simply cannot afford that type of rent. And so even in the example that I shared, right, with that deal that was presented to me a while back, which on the surface seemed reasonable, but once I peeled the onion, I was like, wow, this is way outside of what the local market will bear. So for that reason, it's important to understand those market dynamics, the supply, the demand, all of that, because it directly then feeds into your assumptions or the inputs that you use to build your cash flow projections and pro forma valuation.
Speaking of markets, do you focus on select markets so that you can essentially become an expert in like what is the vacancy in that hyper local area?
Yeah, so when I started in a single market exactly for the reasons that you mentioned. I wanted to be an expert on it, understand how that market works. Granted, in my business, I find really strong operators who are already based on in that market to help with the day-to-day execution. But still, as an investor, it's important to understand that versus just taking someone else's word for it's the best market in the world, right? And in the beginning too, it makes it easy too when you travel. So with my limited time, it was important to be more focused on a location. So when I go and visit the properties, it made it easier. So for me, that market happened to be, well, I would say it, that location happened to be Georgia, and then within Georgia, there are 3 different markets that I'm currently in, and that's just a function of the sponsor or the operator that I've worked with. But over time, as you gain more experience, as you build your systems and processes, it's not uncommon for people to start diversifying into other markets. So I really think it depends on which side of the syndication spectrum you're in. If you're an operator, I think it's important to be hyper focused on a market, 2, maybe 3 that are within driving distance of where you're located or where your team is located. At least that's what I look for when I select operators. But if you're a capital allocator or a passive investor, at one point you have to start diversifying, right? Because you don't want to be 100% concentrated with a single sponsor in a single market, single business model. So I'm at a place where I'm starting to diversify outside of Georgia because my investors are looking for more diversification. So I want to be able to offer that to them.
That makes a lot of sense.
Like when you first started taking this more active role, how did you balance that transition from your the lender lens, like the doom and gloom, like you mentioned, to the optimistic, gotta get the returns? So what does that balance look like for you, and how has that evolved, especially now as you're looking to diversify your market too?
Yeah, so it definitely took some time and an adjustment, but every time I start a new project or new venture, new activity, I double down on education. So for me, the first step is to get educated, which is why I go back to my mission to educate and empower investors. It's really one of the first steps. When people ask me where do I start, education is the first step. And so I joined a number of groups, masterminds, and And part of the reason I joined them was not only the educational component, which is important, but also the networking. And that's where I connected with other like minded individuals, investors who are active in the space. Because we learn not only from the academic side, right, the courses and modules and all the books that you read and podcasts that you listen to, but also through interacting with people, and really interacting with investors gives us a real time pulse on the market. So having those conversations was also extremely important for me. And not only eventually that resulted in me finding my partners, right, which is again connecting with the right people is probably the most important factor. That's really where it starts. It starts with the operator, then the market. The deal is last. The deal is the easiest thing to pick apart, right? Because it's very technical. That's easy. But the people factor is probably the most challenging part of the equation. So I took my time, right, to figure out who are those like-minded souls that I can partner with, because in the syndication world, at least, right, these are 5 to 7 year marriages that you're getting into. These are illiquid investments. It's not like the stock market where you call your broker and the next day or in 2 days, right, the stock's liquidated, the cash is in your account. And we're talking about hard assets here. It's years, a couple years to execute on the business plan and monetize that investment. So it's not a decision that one should make easily or lightly, or at least it hasn't been for me. I do know a lot of people, they meet at conferences and I like blue, me too. Let's form a partnership.
Yeah, we're like that too. You want to date and get to know
Yes.
each other before getting married.
Exactly, exactly. I think you said it really well. So, and even then, I'll tell you, even then, you don't know, because until you go through a hard time, and for better or worse, these hard situations materialize themselves after you're in a deal. You may have checked all the boxes, you may have done all the steps, you may have asked all the questions, and then you find out that person is maybe not exactly what they said they are. So we all learn as we go, and I had my fair share of learnings as well. Again, I do this not only actively but also passively, and so through my passive investments is how I afford to take maybe on a little bit more risk, so I can be a better fiduciary for my investors on the active deals that I lead. I wish I could say it's been roses and butterflies all the way, but at the end of the day, that's how we all learn, right? It's sometimes through those experiences. So hopefully that answered the question, but
Yeah, it definitely did. And I guess like that makes me think, on this like dating analogy that we're on, what are some green flags that you look for in GPs? Especially when you're like, oh, as an LP, that's a GP that I see myself working with. Apart, like say the numbers look good, apart from the numbers, what are some of those like soft skills or like green flags that make your gut go, oh, okay, like I have butterflies. This is gonna be good.
yes, I like how you said it. So definitely start. So first, I would definitely say follow them on social media, or if you can find them through a referral, meaning a referral from an existing investor. That's a good way to get started and reach out and have a conversation. Or local meetups, conferences. Those are even better because there you can meet them in person. And I understand it's not always possible because people now invest nationwide, right? So they may be in a different part of the country. But if you cannot meet them, at least meet them over Zoom if you can, to get that feeling. But trust your gut feel. I would say that does not mislead you. So if something feels off, I would say just move on. But have that initial in-person conversation or two or three, and then if you decide that, hey, this is someone I think I want to partner with, I've seen a number of their newsletters, deals, I like how they think, I like what they're doing, is understand how they are communicating, how openly, transparently, and frequently they're communicating. If they're not responding to your questions in a timely manner during the dating stage, right, when they're courting you for a new deal, just imagine what it will be after they close, or if they brush you off or make you feel uncomfortable, right? That would be one. I guess you ask for the green flag. I turn it into a red flag,
Yes,
but it will be the opposite,
that's
right?
okay. Yeah, the opposite.
Look for the communication. I will definitely try to obtain references from past investors, and that's a little bit tricky because realistically, just like whether it's a job interview or consulting referral, rarely would people give you a bad reference, right? They'll typically connect you with people who can provide good references on you. But maybe when you connect with that person, you can ask them, hey, can you think of other investors who are in the deal and who may be willing to provide a reference and go that way? Or you can ask for past investors, and there could be a lot of reasons why they're not investing, like their liquidity depleted, they're looking to diversify, they want to go into a different market. So there could be many reasons why they're not um, renewing their investment with that sponsor. But if there are any bad reasons, right, it's through those conversations you will find that out. So I talked about the communication, the references, and then the past performance. This I found to be really tricky because a lot of sponsors would give you their IRR table and the number of deals, but that doesn't really tell you the full story, especially if they bought a lot of these deals in 2020, 2021, when deals were getting flipped pretty much every 1 to 3 years, right? And IRRs were compressing. Every deal looked like a hero. So I will drill down more into the actual NOI versus projections and how that performed, drill into how long the actual hold period was, right? Because if they sold it in a year or two, their IRR would be off the charts. And they should be willing to share that with you. If they start pushing back, and it doesn't have to be in a perfect table format, just get the data, right? But if they start pushing back, that to me is again a reason to ask the question, well, why? And frankly, if they don't have this readily available, what are they hiding? If it's great, normally people are eager to share that, but if there's something's off, right, they may not choose to disclose the information. So those would be maybe three areas that I would focus on
Those are great.
vetting operators.
Yeah, those are really insightful. You touched upon maybe like the benefits of LPs staying with the same syndicator, throughout their deal cycles. What beyond just like familiarity and that personal relationship, what are some other benefits in your mind about with staying with the same same GP team as an LP?
Yeah, so I mean, the trust factor, right, is a big one, and in that case, if they've done multiple deals, that trust is then backed by actual performance, right, and not just words. So you see not only how they perform, but how they operate, how they communicate. Although I will say, and in the beginning, that's great, but I will say over time, it's still good to diversify, right? Because if that one operator goes through the stress, then your entire portfolio goes through the stress, right? Because even if your deals are performing, if they're pinched on maybe a couple other deals that you're not invested in, inevitably that impacts how they behave and what decisions they take. And we're actually seeing that manifest itself in today's market as well. So at some point, it's still good to diversify. Now, if you're working with a fund manager who may be diversified across different operators in different markets, that's a different story. So in that case, if you have a fund manager that you know, like, and trust, I would say that's a great way to proceed because they're going to do the heavy vetting, the due diligence, and still offer you that diversification. But in the beginning, if you have just one or two deals, that's not enough, I think, to say let's now start diversifying. It's
Yeah.
especially again if you have that trust factor and see them operate over a period of time, right? Again, the heydays of cap rate compression are over, so maybe at that time you invested with a sponsor who send you a big fat check every year, and now in the last 2 3 years maybe they've been calling you to send a big fat check back for a capital call. So you know doesn't mean that they were a bad sponsor, bad operator. Who knows? Again, a lot of that will boil down to how is the deal actually performing, how was it underwritten, how was it capitalized, right? Because there are the external factors like the market, but there are also internal factors like the ones I just mentioned. So as long as it's a situation where, hey, they did everything they could to control and offset the market cycles and the market movements, but in the end, right, the market dominated, then at least someone who's really fighting for the deal, even if it didn't perform, that says something versus someone who's brushing you off and kind of surprising you at the 11th hour with a capital call or bad news, or not communicating, or only sending you updates about we painted 5 walls this month. Yeah, When you look at the financials and you see they're bleeding cash, and you wonder, well, why is that not on the investor update, right?
Yeah. Yeah, transparency on both sides, right? Not just the positives. Can you talk a bit about like your first few syndication deals? At that time, like what mistakes did you make? And maybe this was in underwriting or choosing the team. And how did you learn and get past them now?
Well, thankfully, the syndications I've invested in are performing better relative to the current market. So I think I did well from that perspective. But I'll tell you that it wasn't easy, because when I was looking for deals, everyone was closing a deal. It felt like a month or a quarter. And here I was closing a deal, at most one deal a year. And it definitely led me to question myself. Well, am I being overly conservative? What am I doing wrong? What am I missing out on? I think now we all have the answer, right? Now that the market cycle has unraveled and we know where we're here today. So, if anything, for me, that has affirmed that my approach of slow and steady is the one that's worked for me. And it's better to pass on a deal that has an amazing outcome and an amazing return than to get into a one that ends up in foreclosure. So yes, sometimes you may end up passing on the winners, but I'm okay with that, as long as in the long run I can protect mine and my investors' capital. But I have made some mistakes, right? As an LP, I mentioned, as a limited partner, I have invested in deals as well. One, I wanted to have that experience so I can better relate to what my investing partners are experiencing. And two, again, that's how I learn on my own dime, not on other people's dimes. And so there was an investment that I did. It was in a different asset class, hence my comment earlier on diversification. There's a point to start thinking about it, and I think in my case that was too early. But I put more credence in the sponsor than I should have. I went through the steps, I went through the process, but I didn't verify a lot of the information that was presented to me, only to find out later that they haven't been looking at or requesting the underlying financials on the investment, that they haven't done the full deep diligence or have the full understanding of how the business model works, and they haven't been fully invested in the investment. And so unfortunately I found that out later, and that particular investment is most likely going to be declared a fraud. So you may see me on next episode of American Greed. But it was very, very, very painful. I will admit, but it's one of those things where you can lose sleep over it and beat yourself up and think, how could I have not seen that? How could I not have done that? But we all live and learn, right? So now I'm unapologetic, right? If a sponsor doesn't want to share that information with me, it's a pass, and I would rather not do any deal than get myself, in this case, my investors, into that same scenario. So I do ask for sample reporting. I do look through their past performance and deals. If they don't want to share the level of detail I'm requesting, and again, it doesn't have to be in perfect form, but just give me the data. And those are red flags. If they don't respond timely, if they're disorganized in the beginning, because I went through that experience as well. Well-known sponsor as well, had been in the space for quite a while. So again, the longevity, years in the business, through
Mhm.
cycles, that was there. Those boxes were checked, but I should not be finding mistakes in their legal documents, right? And now that's kind of manifesting itself into how the deal is being managed, and it's going through some trouble, and hopefully it will turn around. But that attention to detail was not there in the beginning, and now it's manifesting itself during the actual operation. So if you catch these little slash big things in the beginning, I would say pause, right? There are always going to be investments. Don't rush into it. There'll always be the next deal. And like I said, it's better to miss on an amazing deal or two than get yourself into a bad deal, because it will take you then just twice as long to make up those losses. You have to make 100% return if you lose even 50% of that.
Mhm.
To switch gears a little bit, we've been seeing a lot of like AI related underwriting tools that are out there now. One, do you use them? And two, like as an LP, are you using AI to augment some of your research, especially as you are diversifying into other markets?
Yeah, so I've tried actually several tools on underwriting that are AR related. And the one that I like the most, and just full disclosure, I'm affiliated with them, is the cash flow portal underwriting tool. It is still evolving, but they're actively taking feedback from users. So it's probably a good reminder for myself to try their 2.0 version, which was just released. So that one I found to be the most reliable. But I will say for my underwriting, I'm still resorting to Excel. And I think probably for me, it's that matter of control. I want to see what's in the black box. And when you use an AI platform, each one is set up differently. I don't quite know how the decisions are made in the background. There are quite a few that have emerged and pretty sophisticated ones now that even score deals, on the 4 to 5 scale. So you just click a button and the deal is analyzed for you. But I don't know. I'm still I think we'll probably get there, but personally I'm not quite there myself. I still like to peel the onion. I want to see their assumptions. I want to understand how everything was on. I want to see their model, right? I want to see their Excel spreadsheet. And so understand really the input. So I'm not quite there myself when it comes to underwriting. Again, some of these platforms that I mentioned, they can really expedite the process, at least for a preliminary screen. Like if you're a sponsor or an operator, someone who's actually sourcing deals, I think these tools can be amazing because if you're getting, I don't know, 100 deals a week, right? If they can help you wiggle through the noise so you can spend your time only on the one or two that are truly meaningful. And then I definitely see the added benefit. In my case, I'm on the capital allocation side, and while deals are presented to me, I don't get hundreds of deals a week. So it's very easy for me to just ask for their underwriting model and pick it apart relatively quickly. And then I can make a decision pretty quickly. Is this a yay or nay?
Yeah, we're also capital allocators, and but we specialize in senior living, not multifamily. And I feel the same way. I think we're not in a position yet where the AI models are one, they hallucinate, right? They make mistakes all the time. And if they can't really outline the assumptions clearly enough for that local market, I don't know that I would feel comfortable sharing that with the investors.
Yes. Yeah, absolutely.
So I feel you.
No, I mean, because you have a fiduciary responsibility, right? When you get on a call with an investor, you need to be prepared to go through every single number. And I have some investors who just sign documents. They want the easy button, and so they trust me, which for me raises the bar even higher. I have others who actually go through every single cell in the underwriting model. So if you don't know that, right, how will you explain it to them? And if God forbid the deal goes sour, at least you can look back with good conscience and say, yes, I knew every single number, I vetted it, this is what happened, I did all that I could on the front end to do the diligence. Imagine sitting
Right.
in a room saying, well, AI gave me a 5-point score, so I thought it's a good deal for you guys.
It was a green flag deal. We just don't know why, but it was good.
Yeah, but I sadly I also see that happening. So I'm glad that you asked the question again. Maybe we'll get there eventually, but I'm not quite there yet. And again, for me, that fiduciary aspect, it comes with a really high bar.
Hmm. Yeah, I hear you.
Yeah. That question for you, and I have no idea about this, so this question's like, is there a difference in underwriting between a JV and a syndication? And if so, I guess what might that be?
Yes, so there definitely is, because the end goal in mind is very often different between the JV and the syndication. With the joint venture, oftentimes it's 4 to 5 people, or like 4 to 5 entities. They're very actively involved in the day-to-day management of the asset, and very often those JVs are formed as, I guess you could say, marriages, like forever marriages, right? Forever buy and hold. Of course, there's always the possibility that if you get a an amazing offer, collectively you may decide to sell the property. But when it comes to underwriting, those certain metrics like IRR, for example, become less relevant because the IRR captures the total return that the deal is generating over time, as well as capturing that time value of money. Well, if you're holding the deal forever, right, that becomes distorted. So in those cases, personally, I'd like to focus on the cash on cash return, which is effectively your return on investment. How much income are you generating each year relative to the amount of money that you put in? And so from typically also joint ventures happen to be on smaller properties as well. Again, a lot of that is a function of the capital that needs to be brought to the table, which in most cases is pro rata. If you have four partners, for again, and not in all, but in most cases, right, it will be equivalent amounts of capital. So that limits it to smaller properties where you're not only more hands-on and managing the assets, but your margin of error is also so smaller because you have less units to deal with. And in some cases, one or two vacancy could put you at a break-even point. So it's extremely important, right, to take that into consideration as you're working through the numbers. With syndications, you have a lot more people involved, right? There's the passive investors who don't have the time or desire to be involved in day-to-day operations. There's the general partners. And so the profit splits are somewhat different, where general partners may put in maybe 10% of the equity, but they get 30% of the promote or 30% of the profits. Typically, most cases, investors like to get that a big paycheck within a shorter time frame, usually around 5 years. So I consider those medium term flips in a way, right? This investment will have a 5 year horizon, maybe three if you get a great offer, maybe seven if you have to hold a little bit longer. And so in that case, yes, cash on cash is important, but so is, IRR also becomes a factor to look into. Look at the different waterfall structures and how that's presented. You probably won't see waterfalls, right, in a joint venture. And then there are usually more fees, right? In a joint venture, you're doing all the work yourself. So you're not going to see asset management fees and acquisition fees and things like that. But in a syndication, you will, right? Because now you have GP team doing actively the work. So they need to be compensated for the work that they do and the value that they deliver.
Thank you for that breakdown. That was really helpful. I think it like JV, like, differences between a syndication and a joint venture is something that we haven't talked about prior to this. So it's really insightful for our audience.
Absolutely.
I guess one more question. So I'm going to switch gears a little bit to the market and where we are today. So, in the past week or two, there's been a lot of news about the tariffs. So can you talk a bit about what's your perspective on how whether the tariffs stay paused or don't stay paused? What's the impact to commercial real estate as a whole? And then I think in a more detailed way, like how are you accounting for some changes in your underwriting as you review deals from here on out?
Yeah, so there's definitely a lot going on, right? And only time will tell where the tariffs will say. There's a um I feel like it's a game of who's gonna blink first. That's happening right now, and we are really changing the world order. That is changing, and in the short run, I think it will probably be beneficial for the US, but in the long run, it raises a lot of questions, right, for our position on the world stage. But as I think about tariffs, right, and some will be here to stay, some will be paused, third will maybe phased out over time. All of that will, in my view, increase the inflation factor even more, which actually makes hard assets better positioned to take on that inflation, because ultimately what that does is it creates, right, an additional tax that we as consumers will ultimately end up bearing, or maybe in some cases the importers, distributors will absorb some of it, but maybe not all of it. And so in the short run, that I think creates, even exacerbates the probability of a recession. So if you ask me, I think we're probably already in one, but it's not going to be declared until later in the year. A lot of the leading economic indicators all throughout last year and even this year have been pointing to a recession. And for the longest time, I was wondering, what will start this domino effect? And I think now I have the answer. Part of it is the tariffs, right? Depending on how deep and how long they stay in place. And the other factor I think is the restructuring of the government offices, which will impact not just government offices, but all the ancillary industries that service on those different institutions. And so that may start the wave, right? Because you consumer confidence, producer confidence, those are business confidence. These are all at an all-time low level. The consumer credit is at an all-time high, savings rate as well as at an all-time low. A lot of indicators that show that people are already stretched and dipping into credit. So they're already pulling back, right, on some of the spending. So it's not going to take a lot. Now you're layering a 25% or 100% tax, right, that they have to absorb when they buy goods and services. I think that will inevitably lead to a recession. So in the short run, why that is relevant to commercial real estate is because, again, the rent factor is one that I look at and really look to validate those rental comps to make sure they're reasonable, the assumptions they are reasonable, because that inevitably impacts the valuation, especially in the stable value add space where there is a construction component. We all read about immigration policies. We discussed about the tariffs. So I know both the cost of labor and materials will likely increase. And so
Mhm.
I like to see that there is adequate cushion baked in for that. Of course, nobody has a crystal ball to know how much that will increase. And when I look at stabilization periods, right, if you are faced with a supply chain disruption that's outside of your control, no matter how much you've planned, you want to leave yourself some grace for maybe longer stabilization period. And if it took you 6 months, maybe plan for a year if you can't get your lumber or tile. It will take time for that domestic activity to transition right to the US, for that manufacturing to take hold. So until then, I think supply chain disruptions are real. So these are a few things that I look at least in the short run. But in the long run, I did talk about the inflation factor, right, which positions hard assets in a good place. Also, because of the rising construction costs, labor disruptions with various immigration policies and not, as well as the high interest rate environment we're in today, it's causing a lot of builders to pause, right? The multifamily starts
Mhm.
have dropped off the charts.
I know.
And so that will likely lead to not this year, because we still have quite a few supply to absorb this year, but starting next year, unless that trend changes, right, that will lead to supply shortages 3 to 5 years from now. So for people getting into, personally, I believe in the multifamily space today, they will fare really well, all else equal. That's also a reason why I'll go back actually to one more point on the underwriting, because my belief is that inflationary pressures are here to stay. I don't think rates will fall materially, especially long-term rates, which is what a lot of these
Mhm.
loans or the commercial loans are priced or based on. And for that reason, if rates are going to stay in that, say, call it 5%, 6% space, I have a really hard time visualizing cap rates that will fall below those levels. So again, when I see deals that are presented to me with exit caps that make that assumption, I get really nervous because, again, I don't have a very high tolerance for risk. So I don't like to speculate. And when I see that in the numbers, it definitely makes me nervous. So I would say brace for impact in the short run, and enjoy the fruits of prudent underwriting and diligent decision making in the long run.
But all things being equal, I think you're still saying check your underwriting, make appropriate assumptions, but get into it because potentially in 3 to 5 years, we could be in a better place in the long run
Yes.
because occupancies could be higher, because the supply would be lower potentially, and the rates may have stabilized a little bit more.
Absolutely, yes. I think the period, and only time will prove me right or wrong, but I think the period that we're going through today is the 2009 2010 cycle that multifamily went through after, shortly after the Great Recession or the global financial crisis. Again, we're only going to know that looking back 5, 10 years from now, but when I look at the data, based on what I know today, the next 12 to 18 months will be an incredible opportunity for those who are buying it will definitely be extremely painful and bloody for the ones who are selling. So I don't know if we're necessarily at bottom, but it feels like we're, if not, we're near the bottom of the cycle, at least for multifamily. So, anyone looking to get into the space, I would say the next 12 to 18 months will be a great opportunity to purchase assets at very reasonable valuations. Again, not at all costs, because even today, like I said, I see deals that I think are overpaying. But there are those deals out there. They're diamond in the rough, right? You have to look for it for quite a while, but they are out there. And the only way to find them is to stay active in the space, right? Active doesn't necessarily mean buying deals, but it's looking at deals, reading,
Reviewing them. Yeah.
investors.
Understanding them. Yeah.
Yeah. Bessie, I think this has been incredible. You have been a host of value, and thank you so much for providing so much insight into commercial real estate at large, but also specifically diving deep into underwriting with us. I just wanted to thank you for joining us on Rich Roots and sharing your incredible experience and your story. Where's a good place on social media or online that folks can connect with you and learn more about what you're doing at DBA Capital Group?
Absolutely. The easiest way to connect with me is I hang out a lot on LinkedIn, so definitely there, and I host live events. So in terms of social media, that would be one place I would mention. Otherwise, for people looking to invest passively, my website, DBA Capital Group, D as in dream, B as in believe, A as in achieve. I have a ton of complimentary educational resources there, as well as direct link to connect with me. And for those who are looking to learn how to analyze deals, masteringmultifamilyunderwriting.com is where I share a lot of underwriting insights, and they can find out more about my community there and how I help investors that way as well.
Thank you for our listeners for tuning into this episode of Rich Roots. And until then, grow your wealth.